Hi there. At PTA, we know NFTs are exciting, but HMRC treats them as taxable assets. Today, we'll explain what every UK investor must know.
All right, if you're involved with NFTs here in the UK, you are really going to want to pay close attention. A massive tax crackdown is heading our way in 2026. And look, if you're not ready for it, it could cost you a lot. So, in this explainer, with a little help from the experts over at ProTax Accountant, we're going to break down absolutely everything you need to know to stay compliant and, most importantly, protect your assets.
So, let's kick things off with a number that should definitely get your attention. £535 million. That's not a typo. That's how much extra tax HMRC, the UK's tax office, is planning to collect from crypto holders in just the next few years. And if you're wondering how they're going to do it, well, the answer is a huge new reporting crackdown that is set to change the game for everyone.
You know, this crackdown hasn't just appeared out of thin air. HMRC has been playing the long game here, slowly but surely tightening the screws on crypto holders. It all started back in 2021 with some major data sharing deals. Then, in 2025, they sent out a wave of those infamous nudge letters. But the real hammer drops on January 1st, 2026, with the launch of something called the Crypto Asset Reporting Framework, or CARF. And by May 2027, exchanges will be automatically sending your data straight to HMRC. The days of flying under the radar, they're well and truly over.
So how on earth do you prepare for this new reality? Don't worry, we've broken it all down for you into 6 key areas. First up, we're going to dive deep into this 2026 reporting revolution. Then we'll help you figure out if you're looking at capital gains or income tax, a crucial difference. We'll also pinpoint exactly what actions trigger a taxable event, give you a compliance checklist, show you the costly mistakes you have to avoid, and finally, lay out your next steps. Okay, let's get into it. What is this reporting revolution all about? Well, it's all driven by this new framework called CARF, and trust me, it's going to fundamentally change how all of your digital assets are monitored. The thing about CARF is that it's a global agreement, which basically means there's no escape. Starting January 1st, 2026, all UK crypto service providers will be legally required to automatically collect and report your transaction data to HMRC. And if you're thinking, I'll just use an overseas exchange, think again. Because this is an international agreement, your data is still going to find its way right back to the UK taxman. The message here is crystal clear. They're watching.
And the level of detail they'll be getting is just staggering. We're not talking about a simple summary. They'll have your full name, your address, your date of birth, even your national insurance number. They'll know all your wallet addresses, every single crypto-to-crypto swap you've ever made, every time you've cashed out to fiat, and the exact value of each and every transaction in pounds. HMRC is literally about to get a front row seat to your entire crypto history.
And please, don't think for a second that this data is just going to sit in a dusty old file somewhere. Oh no. HMRC is seriously beefing up its crypto sector team, and they're arming them with powerful blockchain analysis tools. They're not just collecting this data, they're getting ready to use it to come after anyone who isn't playing by the rules.
So, with all this new scrutiny, getting your taxes right is more important than ever before. And that all starts with answering one really critical question. Is your NFT activity subject to capital gains tax, or is it income tax? The answer could have a massive, and I mean massive, impact on your final tax bill. So let's break it down.
Right, so if you're holding NFTs as a personal investment, you'll most likely be paying capital gains tax when you sell, swap, or spend them. The rates for that are 18% or 24%, depending on your income. But, and this is a big but, if you're a creator or maybe a high-frequency trader, HMRC is going to see you as running a business. And that means you'll be on the hook for income tax, which can go all the way up to 45%, plus national insurance. That is a huge difference, so it is absolutely essential that you know where you stand.
Now, let's talk about the tripwires. What exactly does HMRC consider a taxable disposal? Because it's not as simple as you might think, and honestly, this is where a lot of people get into some serious trouble.
Okay, let's run through the triggers. Selling an NFT for pounds, that's a no-brainer. Of course, that's taxable. But did you know that trading one NFT for another is also a taxable event? Or that gifting an NFT to a friend can trigger a tax bill at its market value? And here it is, the one that catches almost everyone out. Buying an NFT with crypto. The moment you use your ETH to buy an NFT, you've technically disposed of that ETH, and any profit you've made on it up to that point is now taxable. Really, the only common ways to avoid an immediate tax hit are gifting to a spouse or just moving assets between your own wallets. And this is where NFTs get really, really tricky. Unlike something like Bitcoin, where you can kind of average out your costs, HMRC sees each NFT as a unique, separately identifiable asset. Think of it like this. You can't average the cost of a Monet and a Picasso, can you? You have to track the purchase price and sale price of each painting individually. Well, it's the exact same for NFTs. You have to track the cost basis for every single one. And that can make record keeping an absolute nightmare. So with all this complexity, how do you stay on the right side of HMRC? Well, it all comes down to one thing: meticulous record keeping. Let's look at exactly what you need to be tracking. In this new world of crypto tax, your records are basically your armor. For every single transaction, you need to log the exact date and time, the assets involved, the value in pounds sterling at that moment, any fees you paid, like gas fees, and the type of action it was. And you better believe you need to keep those records safe for at least 5 years, because if HMRC comes knocking, they'll be your only line of defense. Now, there is some good news. There are some tax-free allowances you can use. For the 2026/27 tax year, you can make up to £3,000 in capital gains and £1,000 in trading income without paying a single penny in tax. But, and you knew there was a but coming, don't get complacent, because there's a catch, and it's a big one. This is the rule that trips up so many people. If your total sales proceeds in a year go over £50,000, you must file a tax return. And that's true even if your net profit is zero, or even if it's below that £3,000 allowance. It's a tough break for high-volume traders who might be churning through a lot of assets without actually making much money, but that's the law. Please, don't let this one catch you by surprise. All right, now let's talk about the landmines. These are the common mistakes and misunderstandings that can completely blow up in your face and lead to some pretty serious penalties. So what do you do with that NFT that's now worth less than the gas you paid to mint it in the first place? Is there any way you can at least get a tax break for your trouble? The answer is yes, you can. You can actually turn that worthless NFT into a tax-saving opportunity. You can either burn it by sending it to an unrecoverable address, or you can make a formal negligible value claim with HMRC. But you have to be proactive about it. You can't just let it sit there gathering digital dust in your wallet and expect to get a tax deduction. You have to take action, and you have to document it properly. And here's the professional tip for all you creators out there. Just minting an NFT doesn't actually trigger a tax event. But the gas fees you pay to create it, those are a deductible expense. So make sure you track all those costs, because they can really help you reduce your tax bill when you finally sell your masterpiece. Wow. Okay, we have covered a lot of ground. So let's quickly recap the key takeaways and talk about your best next steps from here. So here's what you absolutely need to remember. Number 1, privacy is dead. Assume HMRC is watching. Number 2, every single swap is a disposal and potentially a taxable event. 3, your records are your lifeline, so be meticulous. 4, know your tax status. Are you an investor or a trader? And finally, number 5, use your allowances wisely, but never, ever forget that $50,000 reporting rule. If you can get these 5 things right, you'll be in a much better position to navigate the new world of NFT taxes. Now, of course, I have to say that this explainer is for general guidance only. It is not a substitute for professional tax advice. Everyone's situation is unique, and the rules are always changing. So please do yourself a massive favor and talk to a qualified professional who can look at your specific circumstances. Look, the tax landscape for NFTs is changing incredibly fast, but you don't have to face it alone. The team at Pro Tax Accountant can help you make sense of all this and create a solid plan that's right for you. I'd really recommend getting in touch with them today to get prepared for 2026. Thanks so much for joining me, and don't forget to subscribe for more updates.